Imagine this. You just opened your investment account and saw the numbers. Tiny. Almost laughable. Maybe a few $100s here, a couple hundred there. You think, is this even worth it? That feeling? That's level 1 of your financial journey. Level 1 is where everyone starts. Net worth near zero, contribution small, growth almost invisible. Emotionally, it's frustrating. You see others talking about side hustles, rental properties, or hot stock tips, and wonder if you're falling behind. But the truth is, the math is patient. It's silent. This is where your first principle begins. Consistency over excitement. Think of your money as a second employee. He doesn't sleep, doesn't take vacations, doesn't ask for a raise. He just works, quietly compounding day after day, month after month, year after year. At first, he's almost invisible. Your $100 or $200 monthly contributions feel tiny, and the balance barely moves. But every deposit counts. Every month, your second employee shows up. Let's look at some simple math. If you contribute $200 a month into a broad S&P 500 index fund with an average annual return of 10%, after 5 years, you've added $12,000. Your portfolio might show around $14,000. That extra $2,000 is the first hint of compounding. It seems small, but it's the foundation for everything that comes next. The biggest trap at level 1 is impatience. Many people abandon their plan because growth seems too slow. They chase trends, jump from fund to fund, or withdraw entirely. Each time you interfere, you reduce your compounding engine's effectiveness. You fire your second employee before he's fully trained. Here's your first challenge. Comment yes if you've ever felt your savings are moving too slowly, or no if you're committed to letting compounding work silently for you. This is your first step in recognizing your current level. Stay with me, because next we move to level 2, the growth phase. Here, contributions start showing real impact, compounding accelerates, and behavioral traps grow bigger. Your second employee begins to pull his weight in ways that will surprise you, and the stakes start to rise. Level 1 is all about laying the foundation. Your net worth is still between $0 and $50,000. Growth is slow, almost invisible. Your contributions seem minor, but this is where habits matter more than numbers. Emotionally, you might feel discouraged. You've been contributing $100 or $200 per month, and your balance hasn't skyrocketed. You see friends buying houses or investing in side businesses and wonder if you're falling behind. The key here is perspective. Compounding is working quietly in the background. The second employee is showing up every month, even if you don't notice yet. Here's the math. Contributing $200 a month into an S&P 500 index fund at a 10% annual return. After 1 year, you've invested $2,400. The portfolio might show $2,520. That extra $120 is the first work done by your second employee. By 5 years, you've contributed $12,000, and your account shows about $14,000. Slow, yes, but every step builds the base for the next level. Traps at this stage are subtle but critical. Many new investors pull money out during small market drops or try to chase trends. Each interruption reduces the second employee's output. Consistency now is more important than speed. Automating contributions, even small amounts, ensures your second employee keeps clocking in. Behavioral habits here set the tone for decades to come. Don't compare yourself to others' shiny investments. Ignore social media hype. The goal is discipline, not excitement. The smallest, consistent contribution grows far larger than a sporadic, frantic attempt to catch up. Think of it like planting a seed. At first, growth is invisible. You water it, it gets sunlight, but it doesn't appear to grow. Years later, the seedling becomes a tree. That's level 1. Your role is to keep watering without panicking. Challenge for you. Commit to a small, regular monthly contribution. Automate it if possible. Comment "Go" if you'll let your second employee work undisturbed for the next 5 years. Next, we'll enter level 2, growth phase. Here, net worth climbs to $50,000 to $300,000. Compounding accelerates. Behavioral traps become more tempting and more costly. You'll begin to see the true power of letting your second employee work quietly while you live your life. Welcome to level 2, growth phase. By now, your net worth is roughly between $50,000 and $300,000. The second employee, the money compounding silently in the background, is now fully clocked in. You can start seeing the results of consistent contributions. But here's the catch. The higher the stakes, the easier it is to make mistakes. Emotionally, this phase is a roller coaster. You're finally seeing your balance grow beyond what you've personally contributed. But it still feels slower than you expect. Friends are talking about investments in rental properties, hot stocks, or cryptocurrency. Social media seems filled with people getting rich quick. The temptation to chase these options is the first major trap of level 2. Let's look at the numbers. Suppose you've contributed $800 a month for 15 years into a broad S&P 500 index fund, historically returning around 10% per year. Your total contributions equal $144,000. Your portfolio balance could now be about $230,000. That extra $86,000? Pure compounding. Your second employee is now pulling more weight than your own contributions. And this is only the beginning. The key behavioral traps here are subtle but powerful. Many investors start tweaking allocations, chasing sectors, or moving to high-fee active funds. Fees alone can eat into compounding. For instance, a 1.5% annual expense ratio compared to a 0.03% index fund can cost over $200,000 over the next decade. Every time you interfere unnecessarily, your second employee's output is reduced. Sequence of returns risk also starts to loom, although the impact is less visible during the accumulation phase. Market corrections feel uncomfortable, but if you stay the course, you are buying shares at a discount. Each dip is a discount for your second employee to work harder, quietly compounding your wealth. Here's the critical insight. By staying disciplined in level 2, you lay the foundation for the acceleration phase in the next level. Contributions begin to show real impact, compounding accelerates, and emotional temptations intensify. The behavioral tax, the cost of selling at the wrong time, can reach hundreds of thousands if ignored. To navigate this phase successfully, implement 3 rules. 1. Keep total costs below 0.2% where possible. 2. Record every urge to sell, rotate sectors, or chase a hot investment, and delay action for 72 hours. 3. Maintain automated, consistent contributions, no matter what the market does. By the end of level 2, you'll start to notice the real power of compounding. The growth is becoming visible, and your second employee is clearly outperforming your manual efforts. This is the tipping point, where many investors either stay disciplined or get distracted, potentially losing hundreds of thousands of dollars in future gains. In level 3, the acceleration phase, your second employee dominates entirely. Contributions become secondary, and a single decade can generate more wealth than the previous 2 combined. Behavioral mistakes now carry higher stakes, and the math becomes almost violent in its growth. Stay disciplined. Your compounding engine is about to enter overdrive. Welcome to level 3, acceleration phase. Your net worth now ranges between $300,000 and $1 million. This is where the second employee begins to dominate. Contributions are still important, but they are secondary. Most of your growth comes from compounding itself. Emotionally, this phase is dramatic. You start to notice numbers growing faster than your salary or any side hustle. This is the point that surprises most people. After decades of disciplined investing, compounding begins to work in overdrive. If you've contributed $300,000 over 20 years, your portfolio may now exceed $1 million. That extra $700,000? Your second employee working silently, consistently, and powerfully. Behavioral traps become more dangerous here. Investors often sell during a correction, chase hot sectors, or switch to higher-fee funds. Even minor mistakes at this stage can cost hundreds of thousands over the next decade. This is the behavioral tax in action. Sequence of returns risk also matters. A major market drop near retirement can force you to sell investments at a loss, permanently damaging your compounding engine. The key is to stay invested, keep fees minimal, and avoid unnecessary changes. Meet Marcus, 42 years old, with $180,000 invested. He feels behind and explores alternatives: individual stocks, real estate, sector bets. The danger isn't the investments themselves. It's introducing complexity, higher costs, or emotional volatility. His real task is patience. Stay in the system long enough for compounding to accelerate. Every correction is an opportunity, a chance for the second employee to acquire assets cheaply. Rules to follow in Level 3. 1. Keep total fees under 0.2%. 2. Delay any market-driven changes by at least 72 hours. 3. Ensure contributions are consistent. Let the second employee do the heavy lifting and ignore distractions. By the end of this phase, you'll realize the first 2 decades felt slow intentionally. Compounding starts quietly and then accelerates aggressively. Level 3 proves the power of long-term discipline. The second employee now works harder than you ever could manually, and your portfolio is positioned for exponential growth. Next is Level 4, Peak and Pre-Retirement. Here, we'll explore safe withdrawal strategies, cash buffers, tax planning, and how to protect your compounding gains before retirement. Mistakes in this phase can undo decades of growth. So understanding and planning for this stage is critical. Level 4 is Peak and Pre-Retirement. Your net worth has grown to $1 million or more, and your second employee is now at full productivity. The challenge shifts: protecting what you've built. Emotionally, this phase can be stressful. You feel pressure to preserve wealth while maintaining lifestyle expectations. Every decision now carries amplified consequences. Market drops, high withdrawal rates, or poor tax planning can undo decades of compounding if not managed carefully. The first critical tool here is a cash buffer. Roughly 1 to 2 years of living expenses in low volatility accounts ensures that you avoid selling investments during market dips. These dips become opportunities to buy more at a discount rather than emergencies. Your second employee keeps working while you live off the buffer. Next, minimize costs. Even small fees compound against you over decades. Active funds or advisors charging standard AUM percentages can cost hundreds of thousands over a decade. By staying in low-cost index funds, you let the second employee keep his full paycheck. This ensures that compounding continues uninterrupted. Tax planning is the final frontier. Understand the difference between Roth, traditional 401ks, and taxable accounts. Proper structuring ensures compounding isn't eaten away at the critical moment. For example, $1.7 million in a Roth is fully yours, tax-free. The same amount in a traditional account, with required minimum distributions, could lose $374,000 to federal taxes. Small decisions made decades earlier have enormous impact now. Consider Claire, 58, nearing retirement, with $1.5 million invested. She's disciplined, but faces sequence of returns risk. If she retires into a 28% market drop and begins withdrawing 4% annually without a cash buffer, she risks depleting her portfolio prematurely. Even perfect accumulation can fail if withdrawals aren't structured before market stress hits. Rules to follow at Level 4. 1. Create a cash buffer of 1 to 2 years' living expenses. 2. Minimize fees. 3. Optimize account types for taxes. 4. Plan your withdrawals before retirement. Protect the second employee at all costs. In the final segment, we'll recap all levels. We will show how your second employee can create millions if uninterrupted, and demonstrate how behavioral taxes, fees, and sequence risk stack up. We'll finish with a signature CTA, reinforcing consistent, boring, mathematically proven actions. The key takeaway? Decades of compounding have built a powerhouse. Now it's time to protect it. Avoid unnecessary fees, delay emotional reactions, and plan your withdrawals carefully. Let your second employee continue to work quietly. Your future self will thank you. Let's recap your entire journey. Across 4 levels, your financial growth has been a story of patience, discipline, and the silent work of your second employee. From Level 1's tiny contributions and invisible growth to Level 2's first visible gains, you've learned to stay consistent and avoid behavioral traps. In Level 3, your second employee began to dominate. Contributions became secondary. The math started to work for you in a nearly exponential way. Behavioral mistakes here, like chasing hot investments or paying high fees, could cost hundreds of thousands. Sequence of returns risk also started to matter, but disciplined investing and patience kept your growth on track. Level 4 is all about protection. With net worth exceeding $1 million, the focus shifts to withdrawals, taxes, and safeguarding compounding. Cash buffers, low fees, and smart account structures ensure your second employee continues working efficiently. Mistakes now can undo decades of progress. So planning your withdrawals and protecting your portfolio is crucial. Now, imagine the cumulative effect. Your contributions were dwarfed by the work of your second employee. Every dollar you invested has been multiplied many times over, not by luck, but by the predictable, patient, and powerful mathematics of compounding. Avoiding behavioral mistakes, unnecessary fees, and poorly timed withdrawals has been your real superpower. This is your call to action. The journey isn't glamorous, and it requires boring consistency. But if you apply these principles, you can achieve the kind of wealth that many only dream about. If this strategy just upgraded your financial IQ, hit that like button. Consider it your down payment on future success. Subscribe to join the 1% who understand the silent power of compounding. And one final comment challenge. Type plan if you're ready to implement these strategies systematically, or me if you've already experienced the benefits firsthand. Keep the second employee working for you every day, quietly, relentlessly. Remember, the system does the work. Your job is to set it up correctly and resist the urge to interfere. Each level of your journey has been about building discipline, avoiding behavioral traps, and letting the mathematics of compounding generate wealth for you. Stay consistent, minimize fees, plan your withdrawals, protect your growth. Let your second employee work, and decades from now, you'll look back and realize the seemingly boring steps you took were the most powerful financial moves of your life. Consistency, patience, and discipline. These are the real keys. And as you follow these steps, your journey will continue, one level at a time, with your future wealth quietly building in the background. Keep your focus. Let compounding do the heavy lifting. And remember, the most powerful employee in your financial life is already working for you every single day.